Hi everyone. Let's begin with our capital structure and leverage analysis. Okay, capital structure and leverage analysis. We were talking about a lot about what is financial management, and financial management we spoke about investment decisions, which leads to our financial decision, and in financial decision we have to understand how are we going to have the funds which will enable us to have our capital assets, use of that funds in our capital assets. So capital structure basically is to know that from where are we going to raise the funds, whether it will be in the form of equity, okay, or whether it will be going to be in the form of debt or only equity. What and which source of capital should we take up? Okay, so any amount of capital, if you see a balance sheet, it will be capital, but which capital it is? Equity capital, debt capital, preference share capital. Okay, what is it? So we need to know that. So now, type of capital structure, every organization have a different way of financing, planning. So some people understand in taking only debt, some go only for equity. There are certain companies which have a zero debt, okay, like Infosys, okay, ACC, okay. There are certain companies which have a huge amount of debt and there is hardly any equity, okay. So say for example Adani. So horizontal capital structure is basically that capital structure which has a zero debt component in their mix. So there is capital debt which we are talking about, own funds and borrowed funds. There is no borrowed funds, so they have a zero debt component in their capital structure, and this particular structure is known to be quite stable, okay. They do all their investments decisions, financing decision, they take it either through a form of equity or they will resort to their retained earnings which is there with the organization, okay. There is no leverage, however, there is a lack of financial leverage, obviously, because there is no loan, okay. Profitability of disturbance of the structure is remote. Obviously, profitability of disturbance, there is no problem in whatever is being generated, the amount of profit obviously belongs to the equity shareholders. Vertical capital structure, I gave you the example of Adani. So it is here, there is a very small amount, the base is a very small amount of share capital, and they have more of superstructure of preference share capital, and debt is built, okay. Debt amount is more, okay. The entire need of new capital is in form of debt. Here even the retained earnings are low. Why? Because the dividend payout ratio is very high, okay. The amount of dividend paid is more, so retained earnings are also less. There is a pyramid shaped capital structure, okay. Here the large portion is there of equity share capital and retained earnings which have been plowed back into the firm. So basically here whatever are the retained earnings, that is only used for your financing, okay. That is only used for your future financing, okay. So the cost of share capital and retained earnings of the firm, here basically they say that this two, retained earnings and cost of retained earnings, is obviously they say is less than your cost of debt. So the most cheapest form of your financing is your retained earnings, so they first switch to that only. Next is your inverted pyramid shaped capital structure. It is the same thing. Here also there is a small component of share capital and there is a reasonable level of retained earnings, okay, but there is an ever increasing component of debt. Here again whatever is needed as a finance is taken in form of debt, increase in the level of debt. Here the retained earnings are also high. The difference between the inverted and the vertical capital structure is, in vertical capital structure retained earnings are very low. Why? Because the dividend payout ratio is very high. Here retained earnings are there, but they understand in taking more debt, okay, they're taking in more loan. Obviously whenever you start taking more loan, there is obvious payment of interest which will in long run will reduce your retained earnings. Okay, these type of capital structure, they are highly vulnerable. They can collapse because they are inverted pyramid. They can collapse fast. The base is very weak. Okay, inverted. This type of a capital structure. This is a pyramid, very strong. Okay, this is vertical. They are very prone to hostile takeovers. Okay, hostile, small equity share capital, no, anybody can take over. And these are horizontals, like this, horizontal capital structure. Okay, now significance of capital structure. Why is capital structure important? Okay, basically it will first reflect you the firm's strategy. It will help enable an investor to understand that what does a firm do, whether they have equity more, whether they are more into the debt, how risky is for an investor to invest. It will enable them to know this. Okay, so capital structure will reflect a firm's strategy. Also, it is obviously, once you know the strategy, you will be able to ascertain the risk profile of the firm. It also acts as a tax management tool, because interest amount is involved. When you pay interest, your tax to that certain extent comes down. It helps to brighten the image of the firm. Okay. Now, capital structure and financial structure, two main important terms. Capital structure is your capital assets, the funds which are needed for long term only. Long term. But financial structure is a broader term. It involves both short term and long term. It also has working capital related finance also we are talking about. Okay, so sources of finance. Sources of finance we need to ascertain in order to run our business. To run our business, we need both. We need capital assets. We also need working capital. So long term, short term, both has to be addressed in financial structure. Okay. So capital structure relates to long term deployment of creation of long term assets. Deploying funds for long term assets. Financial structure, it is for both long term and short term. Capital structure is the core element, one of the core element of the financial structure. Capital structure can even exist without current liabilities. Okay, so basically when there are no current liabilities, your capital structure will be same as your financial structure. Okay, but generally we cannot have any situation like that. Okay. Components of capital structure may be used to build up the level of current assets, but the current liabilities, okay, current liabilities should not be financed, okay, should not be used to finance by the acquisition of fixed assets. Okay, so basically we say every current asset has corresponding current liability, and your long-term financing, okay, your capital, long-term capital is obviously corresponding to your long-term assets. Okay, so then when we are talking about capital structure, we want to know which structure will give us the best result. So which is an optimal capital structure? So if a financial manager is to be asked that what should be the optimal capital structure, what should be the best, whether debt, whether equity, okay. So optimal capital structure of a company will be that which will be the most ideal. Okay, it gives a balance between the debt and the equity, and it minimizes the firm's cost of capital. Okay, a firm's cost of capital. So where the firm's cost of capital is minimum, okay, and there is maximum return, okay, earning per share of the organization is maximum, maximization of shareholders' wealth. That will be known as the optimal capital structure. Okay, so what were the factors which will influence the capital structure? First, current position of the cash flow. What are we currently at? How much equity we have? How much debt we have? How much is our interest coverage ratio? Are we able to make enough of profit wherein we are able to cover this current interest and in future if we are taking any loan. Your debt service coverage ratio. Okay, this is the important position of the organization to know that whether they will be able to give preference, dividend, debenture, interest, dividend, etc. Debt capital payment which they have to do. Are they in that position to do that or no? Return on investment, cost of your debt, tax rates are important, cost of equity share capital, all this. Okay, so basically your entire lesson or concepts of cost of capital, flotation cost, risk consideration, whether there is an operational risk, business risk which is known about, okay, which is associated with your regular activities, operational activities of your business, or whether there is a financial risk, your ability to pay the principal and the payment of fixed financial cost is your financial risk. Flexibility of the organization. Okay, flexibility means that if need be, amount of capital in the business would be increased or decreased easily. Reducing the amount of capital in the business is possible only in case of debt capital or preference share capital, because in case of equity you have to do buyback. Redemption of preference shares, their preference shares are redeemable, debentures are redeemable, loan is repayable. Okay, so obviously it leads to decrease in the capital immediately, but equity is for long run, right? Control. Okay, what is the control of the existing shareholders, owners, what are over the affairs of the company? Because whenever there is an equity share capital which is again taken, like when you raise funds through the equity, there is an invitation of the external owners coming in your company. Increase of the owners. Equity shareholders are the owners. They are the ones who are coming and sitting in the AGM, taking the decision, passing the resolutions. So all this has to be taken in mind. So control is also a very important factor. Then the regulatory framework of our government and all the other laws. Stock market conditions. Okay, the trend in the upward trend, low downward trend in the market, selecting the source of finance also depends on your stock market condition and capital structure of other companies which are operating at the same level, similar industry, same product. You can obviously have an understanding of these type of companies also. Now capital structure theory. Okay, net income approach, net operating income approach. If you all have done the sums, it will be very easy for you all to understand. Now see, net income approach with the help of the diagram. Okay, net income approach, what do they say? That the KO is decreasing. KO keeps decreasing. Your overall cost of capital decreases. How? This is the cost of capital on y-axis, and on x-axis there is this degree of leverage. Okay, your interest, cost of capital on y-axis, and then there is a degree of leverage, your risk basically. Now when there is a debt, FD, okay, or a debenture, etc., which is risk free, totally secured, the cost of your debt is say 6%. Okay, there is no risk as such, and the company, okay, the cost of debt remains the same. And now there are equity shareholders. Equity shareholders, their return, expected return is obviously more. So say that is at 16%, your KE. So when you say a net income approach, what happens is your overall cost of capital basically starts falling. Okay, first say you were only having equity, 16% you were giving as a return. Your company was having only equity and they were giving the return of 16% to the equity shareholders. Now they are in need of further capital, so they have taken the source to be debt. Okay, so debt will be 6%. It is over here. Obviously your overall cost of capital, overall average, will keep on decreasing. This is your net income approach. But what has happened is if you see in a practical form, practically if you see this, that if you start resorting or start taking debt, okay, debt is a cheaper form of capital, so this will help you reduce your overall cost of capital. But in long run, that is your net operating income approach, what happens? If you keep on taking the debt, okay, the debt level, basically you keep on increasing your debt level. If you are increasing your debt level, don't you think the risk of the equity shareholders is increasing? Because you are now having more creditors. Yes or no? Right? If your debt level increases, that means you are having more creditors. Creditors are more, that means the risk is more. Risk is more, that means expected return by the shareholders is more. So the debt level, when the debt level increases, with eventually over the period of time, your cost of equity, instead of staying at 16%, will start increasing. Therefore, your overall cost of capital will ideally not change. It will remain the same. Average will remain the same. Initially, I was saying that your overall cost of capital will start declining. Why? Because now you are having more of debt. Instead of equity, now you are taking debt. So debt is a cheaper form. So your overall cost of capital will start falling. Average cost of capital. But if this persists in the long run, okay, you keep on taking debt, the risk to the equity shareholders is more. They start expecting a higher rate of return, so your overall cost of capital actually remains the same. This is your net operating income approach. Okay, this is what even we have done in the sums. Okay, net income approach and net operating income. So let's read this. According to this approach, there is a relationship between the capital structure and value of the firm. Okay, value of the firm. The firm can affect its value by increasing or decreasing the debt portion in the overall financing mix. Okay. Here our assumption is that the cost of debt and equity capital would not change with the change in the level of the leverage. Okay, level of cost, amount of debt. If you keep increasing, okay, your overall cost of capital is going to not change. Okay, KE is seen to go down with the increasing portion of the debt in the capital. KO basically. KO reduces. Okay, KO reduces. But in the net operating income approach is opposite. Okay, here they say that the market value of the firm depends upon the net operating profit or EBIT and the overall cost of capital of the firm. Okay, so value of the firm will change. The financing mix or the capital structure is irrelevant and does not affect the value of the firm. Net operating income approach makes the following assumptions. Okay, here what do the assumption is? The investor sees the firm as a whole, complete, and thus capitalizes the total earnings of the firm to find the value of the firm as a whole. Overall cost of capital remains the constant, and that depends on the business risk. The cost of debt is also taken to be constant. Use of more and more debt in the firm will increase the risk of the shareholders, and thus it will result in increase in the cost of equity share capital. KE will also increase if you will keep on having more KD, more debt in the firm. Okay, the increase in KE in such as to completely offset the benefits of employing a cheap source of fund, which is debt, and there is no taxes. These are the assumptions for net operating income approach. Therefore, here they say that since you are taking more debt, your risk for the equity increases. This will give and make them expect higher returns, which will keep your KO same. Okay. Now the traditional approach is also the same thing, combination of all this. Okay, we just did the first stage. No, in the first stage I told you this is the debt level. Okay, 6%. Okay, 16% was our KE. Right, 16% was our KE. If I keep on taking more debt at the rate of 6%, my overall cost of capital KO starts declining. Right? But in the stage 2, in the net operating income approach, what I said, that if you keep on taking more and more debt, your expected return by your equity shareholders is going to increase. Thus, your KO, which was here, which started declining in the first stage, KO is here only, no? It will remain constant. It will actually not change. And then there will be stage 3, wherein the cost of debt will also increase, cost of equity will also increase with the higher risk in the organization, and therefore it will result in the change also, high average cost of capital. Okay, overall cost of capital will also increase. Okay, so this is what they are showing in the traditional approach, that in the long run, over a period of time, then there will be increase in cost of equity, there will be increase in the cost of debt also eventually, and there will be increase in KO also. Okay, so this diagram is the same thing of all the stages which we did. Now Modigliani and Miller theory, in which he says that over the long run, okay, this debt and equity and all that does not affect over the long run. Okay, market value of a levered firm will be the same as a market value of an unlevered firm. Levered means having a debt. They have a debt. There is no debt over here. Okay, over the long run, both the values are going to come the same. There is no effect, okay, of their mix. Debt and equity mix does not affect the market value of these firms. Why? Because there is an arbitrage movement which is involved. Now, what is that arbitrage movement? Obviously, as and when you will have greater returns in a given organization, you feel that, here I can sell my equity, I'll get more money. So, where there will be more of selling, the value will start falling down. The more, as and when the sell increases, okay, the value of the firm starts dropping. And you will start buying. When you sell, obviously you will correspondingly buy. So you will start buying in the firm which has a lower investment. Okay, so when you start buying, your buying increases. Okay, value of the firm will also increase. So basically, due to the arbitrage process, the firm's value in long run, whether they have equity, they don't have equity, comes the same. Okay, automatically it will become the same. Then you have a pecking order theory. Pecking order is basically you first start with the cheapest form of capital, which is your retained earnings. Okay, first start with retained earnings, then take debt, and then equity share capital. Okay, why? Again, as I told you all before, that when you do equity, issue equity, you are basically, you are inviting the external owners, okay, external ownership into the company. That are not the owners, they are basically only creditors. Retained earning is the cheapest form. Try to use that first, then go to debt, and then go to equity. Okay. Earnings before interest and tax and earning per share analysis. Basically, it is the relationship between your EBIT and your earning per share. Okay, how much is your earning per share? How will you come to know your earning per share? Based on the profit which a organization has generated. Earning per share shows the wealth you have generated for the shareholders. Okay, the use of EBIT and EPS analysis indicates to the management the projected EPS for different financial plans. So you will try to take that capital structure where your earning per share is the most maximum. Wants to maximize the earning per share Okay, so that should be your basic goal. Maximization of owner's wealth, okay, by increasing the value of the firm's equity, right? So say capital structure of rupees 1 lakh, equity share capital of rupees 100 each, debt is 10% per annum. Okay, we can have a capital structure which will give the most optimal capital structure, most highest earning per share. We will go with that capital structure, which we have done in all our sums also. Okay, just give me a second. Now earning before interest and tax. Okay, but now they say that instead of taking earning before interest and tax, take earning before interest, tax, depreciation and amortization. Why? Because depreciation and amortization, again, they are in form of non-cash expenses. So the best way to value and find EPS, you should use the EBIT DA analysis, okay, with the earning per share. Because obviously tax etc are those expenses which are obviously there for your your government regulations. Okay, you're paying the tax, but actually how much of earning per share you have generated, if you want to closely look at the best amount of earning per share, we can compare that with EBI DTA. Okay, now the next part of your capital structure is your leverages. So in case of leverages, we have always done our income statement. We said contribution minus fixed costs will give you net profit before interest and tax. Okay, minus your interest, that will give you net profit before tax, minus your tax, net profit after tax. Okay, but more we were doing, this is the financial fixed cost, this is operational fixed cost, that is what we were finding in leverages, operating leverage and financial leverage. Okay, so operating fixed cost and financial fixed cost is what we are studying in leverages, right? So degree of operating leverage is what? It is defined as a percentage change in the operating income resulting from a percentage change in the sales. So if I am making the full income statement, sales minus variable cost, that gives me my contribution. Then I have my fixed cost, that gives me my NPBIT, minus my interest will give me my NPBT. Okay, so you have your operating fixed cost and your financial fixed cost. Change in the EBIT, change in the NPBIT, basically this NPBIT upon percentage change in sales. That is my degree of operating leverage. But this particular change is due to what? Due to my operational fixed cost. So it is nothing but operational fixed cost will be able to ascertain with the help of contribution upon NPBIT. Where is my operational fixed cost? It is in middle of contribution and NPBIT, no? Operational fixed cost. Operational fixed cost helps me ascertain my degree of operating leverage. It is in between of contribution and NPBIT, or earnings before interest and tax. Same thing, this is my degree of operating leverage. Okay. So here there is one sum, company A and company B, sales minus variable cost giving me contribution less fixed cost giving me EBIT. Okay, so if I have to find the degree of operating leverage, contribution upon NPBIT, 12,50,000 upon 5, 2.5 times. Similarly for company B, it is 3 times. Degree of financial leverage as per my income statement. Here my financial, I will make it again. Okay, so financial leverage basically from contribution minus fixed cost, I got EBIT, minus interest, I'll get EBT. Okay, so this is the financial fixed cost. It is going to help me a certain degree of my financial leverage, which is nothing but EBIT upon EBT. Okay. Financial leverage is calculated as operating profit EBIT upon profit after tax or profit before tax or after tax, whatever is given, or percentage change in the taxable income upon percentage change in the operating income, percentage change. Then alternative definition, percentage change in the earning per share percentage. Obviously after having NPBIT, I minus my interest, I get NPBT. I subtract my tax, I get my net profit after tax. If I will divide that by number of shareholders or number of shares, I'll get my earning per share. So percentage change in earning per share percentage and percentage change in NPBIT. That is my degree of financial leverage. Difference between financial leverage and operating leverage is very important. Okay, you all can go through this. Financial break-even point. Generally we say break-even point is at that point where your net profit is zero. There is no profit, no loss. No profit, no loss. But my financial break-even point is that profit, okay, it is that point wherein my earning per share is zero. Okay, earning per share is zero. That will be my financial break-even point. So it is basically that amount of profit, okay, or that point, financial break-even point is that point wherein you are able to absorb all your financial fixed cost. Financial fixed cost, which is in form of interest, which is in form of preference dividend. It is a financial fixed cost. Okay, so financial break-even point, it is that level of EBIT at which earning per share is equal to zero. Indifference point is that point in which earning per share will not change. Okay, there is no change. It is that point at which different sets of debt ratios are there, and however, even because of that, earning per share will remain the same. Combined leverage, last thing, combined leverage is nothing but the product of your operating and financial leverage product. Degree of operating leverage into degree of financial leverage. So when you put the formulas together, degree of combined leverage is nothing but contribution upon net profit before tax. Or you can even have percentage change in earning per share upon percentage change in sales now. It is from the start to end point. Combined leverage. Both. Combined leverage is absorption of both the fixed costs, financial and operating. Okay. Then working capital leverage, it is only formulas which you need to know. Okay, working capital leverage is used to locate the investment which we have done in working capital or current assets of the company. Okay, so working capital leverage is nothing but the percentage change in the return on investments upon percentage change in the working capital, percentage change in the current assets. Okay, so current assets upon total assets plus percentage change in the current assets is your working capital formula. Then effects of leverage on shareholders' return. This is important. Okay. Why do shareholders look at these leverages and the percentage of leverages, etc.? Operating leverage effect. Okay, percentage change in your earnings before interest and tax is more than percentage change in the sales. Now, if this is happening, this operating leverage will affect the return on investments, okay, or expected to positively. Why? Because at this level, per unit fixed cost will decrease and small increase in sale will obviously increase your EBIT. Okay, return on investments or return on expected rate of return on employment. Okay, so ROE will increase. Operating leverage indicates that how EBIT change if sales will change. We have also done this type of sums. So situation from exam point of view, your sums based on this particular effects is important. Okay, high operating leverage. Too high operating leverage is also not good. The more the higher the leverage, if there will be a little change also in sales, your profit will get affected more. Low operating leverage may be useful when the sales market is fluctuating. Okay, effect of financial leverage. We have to check the real effect of financial leverage. We have to understand how to acquire the additional funds, use of debts, and use of equity shareholders for your additional financial requirement. High financial leverage means incurring a huge debt of borrowing the funds at the lower interest rate, and low financial leverage means incurring a low debt by borrowing funds. Okay, it may affect positively or it may affect negatively. Effect of high operating leverage and high financial leverage, it will increase the rate of return, but it is also very risky. Effect of low operating leverage and high financial leverage, it is optimum combination for bringing optimum rate on equity or rate on investment or the earning per share. Okay, so this is it with your capital structure and leverages. Okay, capital structure and leverages.
Thank you, ma'am.
Okay, thank you so much. Bye bye.